This is a special report from WBRN Radio in Boston on the Boston Red Network on the Numbers Man, our macroeconomic program that we normally present this week in economics. But we do, in fact, have special reports. This one is entitled The Trump Bubble. The market dropped yesterday, and we'll get into that in a minute. We'll start out with some warnings from Alan Greenspan, the former director of the head of the Federal Reserve. This is on the 6th of February 2018. We'll have the latest updates from the Asian markets also as we move along here. But first we'll go to Dr. Greenspan and his predictions, and this was on the 31st of January. There are bubbles in both the stock and the bond market, according to Dr. Greenspan. I think there are two bubbles. We have a stock market bubble and we have a bond market bubble. He was talking with Bloomberg TV at the time. The former predicted a rise in interest rates and the national debt and the budget deficits. We're dealing with a fiscally unstable long-term outlook in which inflation will take hold. In fact, it was very surprising in the State of the Union address that was from DJ Trump that all these new initiatives are not funded. I think we are getting to the point now where the breakout is going to be on the inflation upside. The only question is when. Dr. Greenspan noted that productivity has not risen much in the past 10 years. It's been at around 60 to 62 to 60, a little below 63%. And he cited recent drops in the value of the U.S. dollar versus other currencies. We're working our way towards stagflation. Dr. Greenspan coined the term irrational exuberance, and that is what this market is all about, irrational exuberance. We've been tracking it since the inauguration of DJ Trump. Now, what we had was in 2017, the whole idea of this massive tax cut. Tax cuts are usually given in bad economic times to spur growth. But we had 8 years in the U.S., I use the we there as a collective we, in the U.S. of a rising market. Since the Depression, it started to, in other words, what goes down does occasionally come up. And it was coming up, there's no doubt about that. But however, the situation being the policies here known as basically on the Laffer curve, trickle-down economics. Trickle-down has never worked, and some of the commentators at CNBC were pointing to 1987. 1987 was a different year when the bottom fell out and the Depression almost came about. First of all, the economy was much smaller. It was not globalized at that particular time. Thus, it survived. But you did not have the type of media you had today. There was no CNBC at that time. There was not the internet out there. The global web was not there. We were not interconnected. We didn't have the global economy. We didn't have Twitter, Facebook, etc. to amplify this. In other words, the psychology of the market, we talked about it before. We've not talked about the psychology of the market in terms of social media. We'll get some studies in some future reports here on the Numbers Man program. But what is basically happening here, you have all of this amplified. And if you're getting into, if you recall during the years of President Barack Obama, you had a very pessimistic message going out. It was going out by the Republican Party. They put out a pessimistic message every time advances were made. The participation rate was too low. The rate of unemployment and redundancies was too high. It was going too slowly. but the market did soldier on as one of the, and the Fed had a massive amount of quantitative easing. Why do you have quantitative easing? You have quantitative easing not when you have a good economy, it's when you have a bad economy, and that is winding down. And also notoriously low interest rates. That cannot last forever because inflation is creeping in, is the nature of a modern industrial economy. Period. So in a capitalist economy, what happens is it's not controlled as the Chinese economy under the direction of their Chinese Communist Party. They cannot control everything, but they can control 85 to 90% of it, or they can put the brakes on and less damage is caused. Here, the brakes is what has happened from Friday on to Monday. Period. But what has happened here, and Kramer was talking about it, you have people that have sat out of the market because of the news that they heard during the Obama years. And then during the Trump's 1 year, the market was climbing. People started to see their 401ks go up because the market was oversold. It was overvalued. They were not cheap. But does this mean the basic performances of these companies was that much better? It absolutely does not. These were Trojan horses put out there, whether you look at Facebook, you look at Alphabet, Google, etc. Now these particular stocks are beginning to shed. But that has been always the nature of the market. And you have these programs that are out there. The algorithms themselves are not in the exuberant business. They're in the rationality business. Of us, they start the sell-offs. But that is for protection, actually, in the long run of the market. Now, when you get this atmosphere there, do people change their psychology? Not overnight, but the types of people that are new to the market and have only been there since the market's been up recently. Now, the only question is, these people been in the market before? We don't know that yet. We will. The data will come out. But the point is, those people will start backing up. And this whole attitude towards the economy, there was a speech today given by DJ Trump in Ohio, a small manufacturer, that gave the workers a $1,000 bonus. Well, you can give the workers a $1,000 bonus, but that's what we basically call in the vernacular quick cash. It's a stimulus type thing. The whole idea of the guaranteed income, or what it is now called universal income project. One place it's tried is in Stockton, California. It's only $500, but it's basically the same principle. People get their $500, and that $500 immediately goes into the market. In other words, it's immediately spent. So like the earned income tax credit. But at the same time, one has to understand that this is a one-time shot. At least it's a once-a-year shot for sure. And if the market starts to reflect its quote-unquote true nature and the economy, what is going to happen here is this irrational exuberance always halts the fickle business optimism. Doesn't necessarily turn pessimistic, but at the same time, it is not what it used to be. Let's continue on here with the numbers. This is from CNBC. Trump's biggest victory, the tax cut could lead to the demise of his beloved bull market. Well, no doubt about that. And this is some of what has happened. The self-proclaimed king of debt, Trump signed into a law that was in December, lowering the tax rate, corporate rate, to 21% from a 30%. Congressional Budget Office estimated will increase the deficit by $1.5 trillion over 10 years, and by $336 billion in this fiscal year. And this is from Richard Haas here. It would be ironic and politically costly for the president and Republicans if it seems increasingly likely the tax cut deregulation, first by estimating the already strong economy, then by adding to an already large national debt, leading to much higher rates while the market corrects, and no doubt about that. And so what's happened here on Friday, stronger than expected jobs report. Numbers there sent interest rates higher, spiking a 2.1%, a sell-off in the S&P 500. That day, the benchmark 10-year Treasury has been talked about 2.85%. Investors are concerned the Fed will reduce quantitative easing. It's interesting, the Republicans have been calling for the abandonment of quantitative easing for the last number of years, period. So if they've been calling for it, obviously it will happen. The Fed will not keep that portfolio there. Now, Dan Lamb, he's one of these hedge fund billionaire types, called out the risks of inflation to the market last month. Low inflation has been critical for the support of the market, and that is not a normal market. It allowed the Fed to unhurl its rate normalization. He wrote a letter to clients. We are watching closely to see how a tightening labor market, most recently announced wage hikes, will sharpen the future path of inflation. The S&P 500 has rallied 32% since November the 8th of 2016. Trump's election in January, something that the president has heralded many times in public appearances and obviously on his Twitter. The benchmark index is down more than 6% this month through Monday. The market's recent decline comes after the World Economic Forum, where American CEOs embraced Trump's corporate tax cut and expressed optimism over the market and the economy. The extreme sentiment by investors and corporations actually worried one legendary investor. There's a good amount of euphoria out there. That's from Jeff Vinik. I don't remember a time, honestly, maybe back to 2000 when there was so much good news, so much bullishness. And that could also be called so much BS. And every instinct of mine tells me that when that is the case, you should have a little bit of caution. Euphoria can even be infectious to the more experienced investors. Now, it is a little bit different. I remember in the time when I started out in economics, which we had the old timers around. There were some of them around. They were still in the market. But remember the Depression. Now you have investors there, as time does move on, that remember the tech bubble of roughly about 19 years ago, that bubble there, the real estate bubble thereafter, and of course the Depression of 2008. Bridgewater Associates founder Ray Dalio predicted a market blowout rally fueled by cash from banks, corporations, and investors. That was on January 23rd at Davos. There's a lot of cash on the sidelines. We're going to be inundated with cash. If you're holding cash, you're going to feel pretty stupid. Well, that has not happened. As inflation rises from Trump's fiscal stimulus, this key risk for the market, and according to Loeb, means a correction that is ahead for equities even if the economy improves. At year's end, investors who stay in cash may not feel so dumb at all. That is, in fact, a correct view of things as to where they will go. Let us move here to some more of our market segment here. We'll go to Bloomberg, and we will do the numbers at the end of this, but the markets in Asia plunge. The sell-off in U.S. equities can actually be a boom for European Asian markets. That's according to William Hobbs. He's a strategist at Barclays. We have been reducing our overweight to the U.S. A little and focused on continental Europe, etc. This is where reciprocal earning prospects look strong for now, but I wouldn't get into it too much here. From Colin Kinterling, the S&P futures have now paired almost their losses and are flat for the first time in a long time today, and having at one point down 3%. These are just various people here giving their opinions of things. The Asian and Mideast markets in red after equities suffered their biggest sell-off in 6.5 years on Monday. The Nikkei 225 entered correction after falling 10% from January 23. Markets in Australia, China, India, Pakistan, and the Mideast sharply lower. Other possible reasons for the false systematic trading strategies. Well, we talked about that margin calls, depth of short-term volatility there. And from Foster Wong and various others here. Let me just go back we'll stay on Bloomberg. We will go to Reuters and the BBC as we move. Here, the big headline here. And inflation and more of that out here. Let's just look at the machines here. This is the risk parity funds, volatility targeting programs, statistical programs, armitage they call it. Sometimes the U.S. stock market seems as a very giant science project. I'm not sure who wrote this. Machines have their fingerprint all over this. This is Eleanor Papa and Lu Wang. You didn't need an engineering degree to tell something was amiss on Monday. While it's impossible to say for sure what was at work at the Dow Jones Industrial Average, they fell 1,597 points. The worst part of the downfall felt like machines running amok. For 15 minutes after 3 p.m. In New York, a deluge of selling orders came in so fast that it seemed like nothing breathing had been responsible. The result was a gut check of the epic proportion for investors who before last week had been riding on one of the most peaceful market advances ever seen, and this is when you really watch it. The S&P 500, which last week capped a record streak of never falling more than 3% from any past point, ended the day down 4.1%, and they were lucky, bringing its losses since Monday to 7.8%. We are proactively calling our clients and discussing that the 1,600 point intraday drop is due more to algorithms and high frequency trading than macro events or human running swiftly to the nearest fire exit. He wish. Futures on the Dow and S&P were up about 0.8 as of 7:30 p.m. That was in New York. This is overnight type of work. What was frightening was the speed at which the market tanked. That's from Walter Bucky Hellwing in Birmingham, Alabama, who helps oversees a $17 billion fund. The drop in the morning was caused by humans but the free fall in the afternoon was caused by machines, in other words, algorithms, machine language. It brought back the same reaction that we had in 2010, which was, what the heck's going on here? Well, the thing is, a mixture of things were happening here by humans. Algorithms are algorithms, but humans also sensed that this market was too good to be true. It was just an over-promoted type of market, irrational exuberance running amok. And when you have this type of irrational exuberance, not only in the market, but in the American political fabric, you have problems. Because you hear 24/7 that the economy is good, the economy is great, America is back, and these kinds of sentiments out there. And of course on DJ Trump's Twitter, people start to believe the message. But when they start to see that the message could go south on them, so to speak, then they have some problems. From Marco Kolachevic says signs are sent to systematic traders first by last week's downturn in the rally, and then by the CBOE volatility scale play a central role in Monday's down sell. Theories on how machines interact with have been evolving since the days of the flash cash, the market rupture of 2010, in which the Dow fell 1,000 points before reversing. Back then, expectation was that something had gone wrong on the electronic exchange when shares are traded. Anyway, that was not necessarily the case. Nowadays, the first suspicion alights on a computerized trading who operates everywhere. Well, computerized trading has been around for a while. You can just ask the Mercer's family about that. Mercer made millions of dollars off of computerized trading. One time he was at IBM. There are lots of stops on old-fashioned stop triggers and some algorithm trading. That's from Scott Ware, a senior strategist at Wells Fargo Investment Institute. Hadn't heard of that one before. This is technically driven days. You've got to watch a 50-day average. It might be a magnet. Well, yeah and no here, period. And this is an interesting headline here. DJ Trump, tidal wave of good news while the Dow plummets. Well, no doubt about it. He was out repeating his claim in the Cincinnati speech while the Dow was down almost 1,600. That's a place called Blue Ash, Ohio. We talked about that from the very beginning. Let's now go to Reuters so we can get a little bit more numbers on this epic day here. On our political side, Boston Red will also talk about more of the political impacts of what is going on. Here, the headline at Reuters, one of the sub-headlines is S&P erases 2008 gains. Well, we're only in the second month of the erasing here. Stocks plunged in highly volatile trading on Monday. The S&P 500 and the Dow Jones Industrials indicate slumping more than 4% to 1,600 drop here. The question for the benchmark index and Dow Jones Industrial averages were the biggest single-day percentage drop since 2011. A period of stock market volatility marked by downgrade of U.S. credit ratings, except euro debt. The question now for investors who have ridden a 9-year bull run, so to speak. The bears are back. I always like bears. After regular trading hours on a Monday, the S&P 500E mini stock futures rose 0.7% 0.73%, suggesting some traders expected to open on a gain on Tuesday. Well, you can artificially get a gain. That has happened before, when basically people have what we used to call a gentleman's agreement. Now it's a person's agreement to talk things up, but they don't stay up. That's part of the problem there. Period. Fell on Monday. The White House said the fundamentals of the U.S. economy are strong. That is not exactly correct. The economy was running at a 2.6 annualized rate in the fourth quarter. Unemployment at a 17-year low at 4.1%. Well, it is at a 17-year low at 4.1%, but your problem with unemployment is that you can be at 4.1, and then you can easily go to 5.1 or 6.1 within a matter of a few weeks. That can happen. Monday's decline erased the gains for 2018. Is down, and is now down 0.9% in the year. The Dow is down 1.5% for the year. Now, not unusual. The market has had an incredible run. That's Michael O'Rourke. He's the chief strategist at Jones Trading in Greenwich, Connecticut. I'm sorry. We have an environment where interest rates are rising. We have a strong economy, so the Fed should continue to tighten. You are seeing real changes occur, and different investments are adjusting to that. O'Rourke said, no doubt about that. The Dow Industrials fell 1,175.20, or 4.6% to the S&P lost 113.9 points, or 4.10%. I think it's easy to do that. The Nasdaq Composite dropped 3.78 there, and on Monday the S&P ended 7.8% down from its record in January. Declines came after the Dow and S&P posted their biggest weekly percentage drop since January of 2016. At one point, the Dow fell 6.3%, or 1,600 points. But again, going basically at 1,600 points is what we're talking about. The Federal Reserve is likely to raise short-term interest rates because you do have inflation out there, and you have to remember that the Federal Reserve has its target of 2% inflation. Period. So that has been out there. The benchmark U.S. Treasury note surged to 2.885 overnight, the highest since January of 2014. And we've talked about that before. Broadcom is scheduled to meet with... Oh, wait a minute. Excuse me. We're leaving where we should be here. Anyway, that is some of the news out here on these plunges. It would not be unusual if the market does rise on Tuesday. However, though, if it does not rise on Tuesday, and we look at Wednesday and through Friday through this week, to discern some type of pattern. Now, we also have petrol oil prices fell 1% there, which is much needed relief because the market is it's overpriced right now. Extending falls from previous sessions as global financial markets tumble. This is from Reuters. Benchmark crude at $66.91. That's down 71 cents. That's not bad at all. West Texas Intermediate crude at $63.48. That's 69 cents, or 1.1%. The settlement more than $3 off of this high, but it doesn't really say very much. period there. And it's just, oops. We'll get to Bitcoin in a minute. They've been falling and falling and falling. We'll have to go back to Bloomberg to sort all of that out. But basically, we'd seen, the rig count rose by late January to 765, more than doubled the 361 that were operational in 2016. So you can see quite a bit of that. We also have shale oil jumping, not sure, I'm sorry, jumping 18% from the mid 2016 to 10 million barrels per day. That's slate. That's the American. So some of the things happening in Southern inflation has become the most talked about issue in the market. That is from J.P. Morgan. Sent that particular one out. There, inflation, no doubt. Inflation, however, has been on the upbound. What has been happening in food and energy, something that they call volatile. There's better ways of measuring that, but that has been rising for a very long time. But now we have other prices also rising, and that is what is causing some of the problems here that have been around for a very, very long time period. And then you have these unusual, looking here at Toyota post 54% jump in third quarter profits. But when you see these extreme profits coming about, you have to look with a very large degree of caution about what is going on. Let me just wanted to get the Bitcoin part of this from Bloomberg. We had seen that around. I'm not sure we can find it. From the fortunes of the rich, we'll just throw this in. 114 billion was wiped out. Having a picture of Warren Buffett here. Berkshire Hathaway's chairman was a hit with 5.1 billion. The hardest hit there. Berkshire Hathaway is a big stockholder in Wells Fargo, which plunged 9.2% in the S&P 500. Zuckerberg at Facebook was hit, fortune tumbled by 3.6 billion. I'm just listing some of the people here. Jeff Bezos, he's supposedly the richest character around. His fortune slipped by 3.3 billion. And retail behemoth Alphabet's Page and Bream took hits of 2.3 billion there, and the route followed a modest decline on Friday that erased 68.5 billion. So just kind of showing you where, as they say, the carnage landed, and the carnage did in fact land on many of these people. So there was Bitcoin here, and I've been moving between indexes here. That could have been at CNBC where Bitcoin was, but Bitcoin is down to about 7, perhaps. Let me see where. This is at Bloomberg here. Was it 7,000? Bitcoin's tumbled almost 20% as crypto backlash accelerates as a headline here. Bitcoin tumbled for a fifth day, dropping below, and this is dated, it's just updated. Anyway, dropping below $7,000 for the first time since November, leading other digital tokens lower as the backlash by banks, government regulators against the speculative frizzy. We did a story, incidentally, on Boston Red, the political program about in Kentucky's small-time Bitcoin traders. Digital currency sunk as much as 22% to 6,579 before trading at $7,054. That was in New York, according to Bloomberg, to composite Bloomberg pricing. It has erased about 65% of its record value from $19,511. That was back in December, and anyone on any exchange at 19 or 18 should have sold immediately. That doesn't mean it doesn't come back, but these kinds of situations are more short-term oriented than a long-term. It's not matured to the point where you are going to a long-term. At this, regulators, some in what has been some of the hottest markets, seeking to gain more control. China will block all websites, including foreign platforms related to crypto trading. There and these same in Korea and various other places. So this is one of these currency situations where opportunism comes in, and because in fact it is a very new currency, a new locator, and this is from, let me just go to the business page of the BBC. This is on Asian markets, a plunge overnight. And we've been talking about some of that plunge. We just want to get to see if the BBC has something new here. Overnight from the quote-unquote norm. We're always trying to get it. The better reporting angles we have, the better we are off here. And the Nikkei, I think we reported this one-day drop, the biggest one-day drop since 1990. And it is worse. It's down 7% before pulling back to a 4.7% fall. That comes on the heels of the biggest loss in 6 years on the Dow Jones in New York. The fall follows some good years for investors. In 2017, the Dow was up 25%, helped by a resurgent economy, strong profits, and low interest rates. Now, the key here, I'm going to get my pointer on, is low interest rates. The sellout began last week after a solid jobs report and the Federal Reserve not raising interest rates. Economic news in the U.S. has been stronger than anticipated. That's from Kevin Koh, executive of financial services. Oh, yeah. The Motley Fool. Well, that's so prevalent. The market correction has been caused by positive economic news. That happens. But there's a difference in having positive news and actually having events. Now, for instance, if the tax cuts are here, but we don't really have the full results of the corporate tax cut. About 300 industries have not reported on how the corporations and how it affect them. But if the stimulus package also passed, and they started, but these are now things that are not paid for at all. So if it were out there and they started to actually do some stimulus, and they say, for instance, if the unemployment rate dropped to, we'll say, 3.8 or something of that nature, the labor participation rate is not going to go up. Even if it went to 63, it's not going to 63. It will drop. So in other words, these are things that would cause all kinds of problems. Elsewhere in the region, we did the Nikkei, the Hang Seng 4.5%. In South Korea, the Kopi gave up 2.6%. We don't report theirs. And the Australian, they lost, benchmark, lost 3.2%. We usually don't give that one in our roundup. It's not usually available. But what happened, the heaviest losses in Asia tracked the side of Wall Street investors are reacting to changes in the outlook for the U.S. and the global economy, what might mean for a cost of borrowing. The selling of shares there reflected a larger than a previously anticipated rate hike environment. Well, there is going to be a rate hike environment. In our opinion, the Fed should have raised interest rates at their meeting last year. Analysts say that short-term investors should be prepared for choppy markets, no doubt about that. It'll be different than what they have anticipated. Let's look at the numbers here. We have quite a bit of background already here as far as the numbers. Let's get to the markets. We've given some of this information, so you will see some redundancies here. Is part of what goes on when we do a pre-bang of it. The BBC Global 30 is down. This is on Tuesday, 0.53. In London, the FTSE All-Share down 59.28. This is Monday now. In Amsterdam, on Monday, they're down 7.43. In Frankfurt, the DAC was down on Monday at 97.86. In Paris, 79.15. They were down there on Monday. In Brussels, they were down negative 56. In Madrid, they were also down 146.70 in the negative. In Zurich, they were down negative 120.30. In Moscow, they were down 4.99. In Johannesburg, this is on Friday, we've given this before, 294.82 in the negative there. In Bombay on Tuesday, 890.42 in the negative. And in Karachi, this is on Friday, 45.72. In Lahore on Friday, 45.11. And in Colombo on Friday, 22.01. And we do have in Tehran, they're actually up on today at 225.30. We go to Sydney, negative 198.20. The Nikkei down 1,071.84 today. The Hang Seng today down 1,357.85 or 4.21%. The Nikkei, for those wanting to know, I think we gave this before, down 4.73%. And in Sydney, they're down 3.2%. In New York, the massacre on on Monday, down 11,175.21. The Nasdaq was down 273.42, or 3.8. And the Dow was down 4.60% there. In São Paulo, I just wonder what's happening with São Paulo. 146.7. It was on Monday. And in Mexico, they were down. This is Friday. We don't have a Monday yet. But 648.42 is where they were. Let's look at the commodities here. And we've given some of this, the Brent crude, but we'll get them again here. Brent crude futures were down $1.42 at $67.16. The spot was actually up, and this is on Monday. Now on Wednesday, the spot was up 76 cents at $58.59. West Texas Intermediate today down $1.90 at $63.55. Gold was down $7.90 on the Forex at $1,337.10. Dubai Gold on Monday was up $2.80 at $1,337.30. Silver was down 26 cents at $16.88. Let's go to Euronext Life futures. Let's see. Cocoa was down $71. Robusta coffee down 36 here. The Bloomberg Commodities Index, this was on Wednesday, 85.59. Those some of the things that are going on here as we continue to monitor this meltdown. And it is a meltdown. What will happen today in New York on Tuesday, we don't know at this particular time. But we will be, as they say, looking with anticipation in monitoring it the next few days as to what goes on. And, of course, we're on just the 6th of February, and we don't really know exactly where we will be going with this. This is one of the stages of the markets. Markets have always been basically not stable instruments. What's happened more in macroeconomics now, the markets have become much more of an influence, I should say, on overall. And you can understand the psychology of the market back to Dr. Greenspan and his famous statement at the American Enterprise Institute about exuberance. But when you turn irrational exuberance into a national campaign as a political statement, then you tend to start having problems. We've had problems in the U.S. with so-called fake news, but the problem is with the economy. The economy is actually real news. And if you try to oppose it as the actual news, it does not work out, because there you have hard numbers. Now you have all kinds of projections out there, but eventually you get to some hard numbers, and those are the things that investors actually look at. Now, yes, you can have market reports from various corporations showing their profits up a particular quarter, but then those profits can go down, is the reality of the market. Now, in the U.S., as in many places, the U.K., that consumers make up a big part of the economy. How are consumers going to play into this? If the news continues to be a very rocketed stock market, then there is problems. But you have to understand that people that are actually invested in the market as percentage of population is not that large. Now, you have people that are invested in the market, I think about 30%, through mutual funds. And those are the people that seen their 401ks go up. There's a lot of struggles now in various places that have the old defined pension plans, and these corporations are trying to convince people to go to the 401ks that not already went there. But that takes a hole in things. And in the U.S. here, we've had particularly the Republican Party pushing plans to link our national income program called Social Security to the stock market, at least parts of it. Well, when you have a fairly stable market, that happened under G.W. Bush before his depression, that people start looking that way. People have very, very short memories when it comes to economics, something that truly is not taught in even universities, very much of it, and that is taught is skewed, severely skewed, back to Adam Smith. We won't go into all these characters, but basically gives a very false sense of security in 2018. That is a very, very big problem. And now you're seeing it, but this is only 1 or 2 days of it. This is not a long-term situation as what happened in 2008. It was in the middle of a political campaign between Barack Obama and Senator John McCain. They were both senators actually at the time. And this was the beginning of a depression where things were going down. Banks were being taken, as in the UK they call it, under administration, a complete meltdown. Now this has not happened. However, there's an argument out there for more deregulation of the economy, whether this be in the environmental section, in national parks, offshore drilling, until a catastrophic accident happens. Then that comes about. And in the financial markets, if Sarbanes-Oxley was not, if a Dodd-Frank was not there, then that would create more problems. And then we have quantitative easing, but the Fed, even the Federal Reserve, put the brakes on Wells Fargo. Now, if that legislation were not there, the brakes would have not been put on Wells Fargo, and there could have been a problem there. And this is part of the problem when you have these corporations following irrational exuberance from a national campaign. It all starts to boil into a fake news a situation of the press. So in other words, you have not heard anything from the administration. They can't come out and say, well, the market is a fake news. Impossible. That's where we are on the 6th of February. Numbers man here from BRN Radio in Boston and on the Boston Red Network. Good day. And for those in business, hold your breath. For the consumer, keep your eyes on whatever screen you can keep your eyes on. Good day.